Hey guys, welcome back to 90 Seconds with Chris. Today we are going to talk about balance sheets. What is a balance sheet? The simplest answer to this question is a balance sheet is one of three major financial statements that tell investors how good or bad a company has performed over a given period of time. The other two statements are the income statement and the cash flow statement. Unlike these other two statements, the balance sheet tells you how healthy a company is at a specific point in time. It does this by reporting the assets, liabilities, and equity of a business. This means the accounting equation which states assets equals liabilities plus equity has to hold true in any accurately calculated balance sheet. Back to my bakery example, I needed $10,000 in startup costs, but I only had $2,000 of my money to put down. As a result, I had to raise the difference of $8,000. I raised $4,000 by selling stock to investors, and I borrowed the remaining $4,000 by selling bond notes to my creditors at a 10% interest rate and a 10-year maturity date. I go ahead and use $3,500 of these $10,000 to buy bakery supplies like oven, refrigerator, and mixers, and I decide to keep the remaining $6,500 in cash. At this point, my bakery's balance sheet looks something like this. We have $10,000 in total assets, which can be broken down into $3,500 in non-current assets and $6,500 in current assets. We have zero current liabilities. This is because we have no money to pay out right now, but however, we have non-current liabilities of $4,000. This makes our total liabilities $4,000, which is the money we borrowed from our bondholders. This means our equity is $6,000. Like I said earlier, the accounting equation states equity equals assets minus liability. In this case, our assets is $10,000, liability is $4,000. The difference is the $6,000 in shareholders' equity. Whenever this happens, it's said that the balance sheet is balanced.